So today I want to talk about one of my pet peeves, and that is how your bank may be giving you the shaft. So stay tuned, we're getting started right now. Hey y'all, welcome back. This is another episode of Your Wichita Falls. My name is Debbie Dobbins, and for those of you that watch this channel, you already know that I'm a real estate entrepreneur, but what you may not know is that I am a financial empowerment coach. What do those words mean? I help people find financial freedom. But when you're doing that, you have to actually take responsibility for your finances. And one of those ways is through this mortgage process. Now, I'm here to tell you that all realtors and all mortgage people are not alike. And this is a real life scenario that happened in the last few days. When you've been around for a really long time and you've watched this market and you've experienced this industry for as long as I have, you see a lot of things. And so, yes, did we have a meltdown in 2008? Oh, well, I lived through it. It wasn't very fun. And in 2008, the Dodd-Frank Act was passed, okay? Which is fairly interesting because if you're watching any news today, you know about Silicon Valley Bank, and now I'm going to forget the name of it because Dodd was chairman of the board of that bank that went under, but they're not talking about that. Here's the thing, I really want to talk to you about what the government was trying to do by interceding with the Frank-Dodd Act. And I'm not going to talk about banking, I'm going to talk about it from the mortgage perspective. Because I was right there in the middle of it, actually teaching compliance to mortgage professionals while this law was just coming into being. And frankly, I thought they took the wheel and made it square. It was perfectly fine, but all this regulation came into play. Some really key components that you as a consumer may not even know because you might not have bought your first house prior to 2008. They passed this new form that was a combination of the old good faith estimate and the truth in lending. And it's now called a loan estimate. So they took a one-page document and turned it into 3, or with all the garbage on it, it's like 6. But here's the conversation that was had at that moment. This form is designed to be so simple for the consumer that the consumer can shop for loans and compare them side by side. And in addition to that, the mortgage professional's responsibility is to give the consumer, the borrower, the options that are available to them for various types of loans, which, oh my gosh, that's so fantastic. I actually was doing that all along, but now they made a law out of it. The thing about that is that it is the responsibility of this now licensed professional mortgage originator to share with you as the consumer your options. Not just decide for you what's best for you and your family. Here's what happened just in this last few days, is we had a client that was actually steered by a real estate agent after using my loan officer to go to a local bank, which that in and of itself smacks of things that I'm not going to call them what they are. But this consumer, rather than being educated on the types of loans that are available out there, goes to the bank, which banks do what banks do. They are just a mill. They aren't there to be taking care of your best interest. Let's just put it that way. And you can see that in a lot of different ways with all the banking issues that are going on. But here's the thing, that they decided to just arbitrarily put this consumer, this borrower, into an FHA loan. And that in and of itself, without explaining all the ramifications. Now, sometimes you have to go in an FHA loan because you don't qualify for any other kind of loan. But if you can qualify for other types of loans, particularly a conventional loan, and you are going to get much more benefit and financial wealth building out of it, that lending institution, that loan originator, loan officer should be telling the consumer that, which number one, they didn't do. When the rates fell because of the Silicon Valley meltdown, I called this borrower and I said, listen, first of all, we can get you a better rate, number one. But number two, I want to look at what the bank is sharing with you as far as what your fees and costs are. When I compared side by side, the fees were astronomically higher, number one, but nobody would have told him that had he not been with a broker. And in addition to that, they had him in an FHA loan as opposed to a conventional loan. So let me give you a couple of the nuances of those types of loans and why in this case it was a better choice for him to know that, this consumer, so that he can make a decision to be building his wealth faster and more efficiently. On an FHA loan, although those are great loans, I love FHA loans for borrowers that need to have them. The scenario was on an FHA loan, he was going to pay more for the appraisal, he was going to pay more for the points to buy them down, he was going to pay more for a possible reinspection if the appraisal needed it. And most importantly, he was going to put 3.5% down, which is the minimum requirement for FHA, and he would have to pay what's called FHA mortgage insurance for the life of his loan, which in this case, it was a little tiny loan. It's $150,000, but he will pay $100 going forward for mostly the duration of the loan, in comparison to a conventional loan, which unfortunately the real estate agent was not educated enough to explain to him, because the minimal that they knew, which was their belief being that you, in order to have a conventional loan, needed to put 5% down. That's not true. On a conventional loan, you can put as little as 3% down. In addition to that, there's multiple types of loan programs with Fannie Mae and Freddie Mac that allow the borrower to be considered a first-time home buyer, get a break on their rate, and in this particular case, we put them in what's called a Freddie Mac Borrower Smart program. He then in addition got $1,250 as a credit towards closing costs or down payment. The rate was less. The mortgage insurance was really quite similar, but here's the thing. If he makes extra payments, or in the alternative just makes the regular payments, and once his loan hits the 20% equity value or an 80% loan to value, that mortgage insurance disappears. It goes off. So every time after, it's usually about 7 years, from that point on, that money is not being paid for an insurance premium to the mortgage people through FHA or private in order to support that loan. So in the overall scheme of things, he ended up saving cash to close approximately $2,000 because of the added incentive, and he will go forward with a lower payment each time he pays his mortgage down. Now, here's the thing that I really want you to get out of this, is that there is not one type of mortgage loan. There are so many types of mortgage loans, and what happens with a bank generally is they don't have but two, three sometimes, FHA, VA, and conventional. And their conventionals are typically 5%. But when you have a mortgage broker that has a menu, it's like a smorgasbord of types of loans. Maybe you're self-employed and you want to use bank statements to support your income. Or you're an investor and you want to use just the amount of rent that you're going to get for a property to qualify for the loan. Or you want to have a single family residence that you are going to buy, but you don't have enough to qualify for, so you want a non-occupying borrower to help you with it, a parent, a sister, a brother. There's so many ways that you can show up to get that dream house. That's number one. But number two, you have such a minimal amount of money to invest between having the seller help you with concessions, buy down interest rates, types of loans, interest rate themselves, getting rid of mortgage insurance, looking for better insurance on the property, getting someplace that's got taxes, property taxes, that doesn't have city taxes, that you're more in a rural community. All of those things go into having an expert really understand what it is that your family needs. And in this time where money is really important to people because you're constraining it and inflation is supposedly out of control, you want to find every possible avenue to create that wealth and abundance for you. So, as I said, every real estate agent is not the same. Neither is every mortgage person. What you want to look for is a professional in both of those cases. And I would love to say I do both, which I do. But the thing is that because I see the whole picture, it makes it a whole lot more congruent so that you absolutely get exactly what you need in every circumstance to make that something really valuable for you. And also, one of those things for a conventional loan that I didn't mention in this scenario is the documentation is like so limited. So they were going to put him through an FHA scenario with a ton of documentation instead of a conventional loan with just 3 or 4 different pieces of paper. So at the end of the day, what I always want as a financial empowerment coach is for you to know, how is your money working for you? How can you create wealth and abundance? This just happens to be one of them. But if you have a great realtor and you have a great mortgage professional, you can then shore that aspect up and then work on all the other areas that I love to talk about, which is side hustles and mindset and all of the things that will allow you to be wealthy beyond your belief. So there's 2 more videos coming up, and I hope you'll stay on this channel, subscribe, ring the bell. We post videos twice a week generally. And I would love for you, if you feel compelled, to schedule a Zoom meeting with me in the first comment link below, because I love to share about how you can be more wealthy, empowered, and financially free. So, as I always say, y'all come back now, you hear? Bye-bye.